So, when a lot of normal people are reading fiction or nonfiction books or self help or something like that to go to sleep, I read academic papers about trading the markets. So, one thing that I'm going to start doing, if this video does well and you guys seem like it's interesting to you, I'll end up reviewing them and talking about them on the channel because I spend a lot of time reading them. So, hey, maybe you guys would like the kind of Cole's notes here. So, the beauty of this is that when I'm doing things like building strategies for Stats Edge and testing, I need to get my ideas from somewhere, right? TikTok, generally not the place for really solid strategies that you can kind of repeat over and over again. However, there's a lot of people out there doing really good work and studying the markets and publishing their findings so we can read those. And then, of course, I test them myself. And if it's something that's interesting to me, it becomes part of Stats Edge trading. So that's how kind of the premise of it comes. Either I come up with the idea myself or I read. And we have a whole podcast about this online, Your Own Pockets, if you want to check it out. But really, when it comes to us systematic traders, the idea generation is almost the hardest part because what we have to do when it comes to testing and when it comes to trading is not a lot of work, right? There might be anywhere between 1 and 10 trades a week that I take on my systems now. I'm looking to up that number, but in the meantime, between the times that I get the alerts to take the trades, I'm not sitting there staring at every tick of the market. I'm looking for new ideas that I can then test and then program into the system. So one of those new ideas right here is from this guy right here. So you can read the title here, but essentially the idea was combining momentum indicators or momentum oscillators to try to come up with an idea of potential buy and sell points. This was done on the SP500. We'll take a look at some individual stocks in a minute as well. But here's the basic idea. We're using stochastic, which a lot of people have heard of. It's a very common indicator in the market. And then Williams percent R, which is another pretty common indicator in the market. Both are looking for overbought and oversold conditions. Both are calculated slightly different. So the idea was, okay, well, if we combine two indicators that are looking for roughly the same thing, but are accounted for a little bit differently, if we combine those, does that give us any sort of edge on picking potential tops and bottoms in the market for the long run? So the premise here was, and the setup was really simple. So looking at the SP500, I think is a bit of a hack, and I'll talk about why. And the main reason is just because we know it goes up over time. We know there's a 75% chance every year that the market is moving higher. However, it's not a bad thing to use the SP500 as an overall test to see if there's any edge in the thing that you're doing at all. But we're waiting for the Williams R to get under 80 and then the stochastics to get under, I think it's actually 70 and 25. So we're looking for these to become oversold. When both of them read oversold on the close of a weekly candle, you buy. And then the two exit conditions mentioned in the paper were a 10% overall stop loss, just to put a really wide stop on there on the market, and then to sell when both of these reach oversold territories. So it's not a trend following system or anything like that. You're buying on the way down, you're hoping to flip that back out on the way up. And then this is the back test with using the signal and leverage as well. So the idea was, if we're right very often by buying these dips, which there's about a 90% or so accuracy, not a lot of occurrences, but about a 90% accuracy in this setup. But then we apply leverage every time that we buy by using a either leveraged, or in this case, I bet you could use something like a double or triple if you're really crazy ETF. Then you can increase returns while not spending nearly that much time in the market. You can see a lot of sideways action while you wait for the next occurrence, and vice versa there. So I just wanted to show this paper was published in 2024, but the beginning of 2024, and there was one trade that's happened since then, and that was right in these two areas where you would have bought right here and then you would have sold right there. So that would have been a trade as well. You can see both of these lines got oversold in April, May, and then again overbought as well. You could take that trade as well. And then the reason I was rereading this study, because I actually read it a while ago, but I was rereading it now, is because that same setup happened again at pretty much the lows of this current correction. So that setup happened again. So again, I wanted to go read the study and talk to my assistant GPT about it as well, just to see, right, essentially what would happen. So potentially it would have been a buy last week on the market close, and then you would wait and hold it until again a 10% further move, or the market got overbought there. And this is just a zoomed in look. This candle's a couple days old, but the same premise. We're focusing on this candle right here. This would have been the trigger candle. So I did what I always do. I took this and I threw it into my back tester, and not just a single stock or the SP500. I said, let's test everything. So you're going to trade everything, and you're going to buy everything based off this setup. And this is with really no refinements at all. I can get the stats for you here. There are 75,000 trades in this back test. And with the 75,000 trades, it shows that there is some edge. There's actually a 67% win rate on this strategy. You can see the chart's not the best, even with a 67% win rate. It's because it actually has a negative risk to reward profile, as is, which means you're losing on average 20% on your position, with a 15% stop. And just I didn't put in the 10% stop loss because that doesn't make sense on individual stocks, right? Some 10% is a big move, some 10% is not, but that's why that is. I just wanted to test the raw signals. And you can see, again, some edge better than a lot of people's trading accounts, just doing this, again, on the overall and the entire market. So the idea is that this is where the premise for something that dives in. And if this ends up becoming a strategy that is interesting, then of course this will be part of stats at trading, where I do all the work and I come up with all the strategies. And at the end of the week, I run and I say, right, this strategy or this ticker has come from this strategy. Here's the rules around it. This ticker has come from this strategy. And I send those out on the weekend so that users can look through them and do whatever they'd like. And then they're alerted in real time when the robot actually triggers. So again, this might be the base of a strategy that I then go start to test a little bit further. I start to do things like, what happens if we put a limit order below as opposed to just buying on the next market opens, or what happens if we're above a certain moving average, or what happens if we are below a certain moving average, things like this. A lot of things that you can end up testing. So that's the basic premise behind that. And then we'll just look at a couple setups that came through here in the real world. So we're always looking at last week's candle just because this is a weekly strategy. So this is the kind of setup it's looking for. And the beauty of it is that as soon as I build the strategy, I can also scan for it. So I can grab another number of symbols here, and we can start to look through some of these and see if there's anything that is interesting. But the thing is, there was a lot of setups last week because the overall market was actually doing that as well. So there might be something that I do there where, relative to market conditions, you end up taking setups based off whatever. But this is one that kind of stood out to me, this Warby Parker. Just the long-term chart looks very nice, nice, strong, solid uptrend here. And then it's pulled back into this zone where it's hit twice. This is how you can combine something like as strategy that has been proven. You can look at it with some evidence to say, yep, there's some amount of edge here that I've proven. And then you can start applying technical analysis on top of that. So it's reached the setup of both these are being oversold. I like this level right here that you're seeing, just because we broke out of the zone, we came back to test it, we're settling into here. So it would be technically a buy on the open of this candle right here. And then your 10% stop loss. I'm going to come up with a better stop loss, I think. And then again, selling when these become overbought. So that's just an alert you could set in the system, and you could sell when those things occur without having to really worry about anything. So just wanted to wanted to review the study. I think it's interesting. It's only 10 results on the S&P 500 that goes up all the time. Doesn't really get me super interested as something that I want to take trades on myself. But like anything, you read things, you look at things, you watch videos like this. If it's something that you like and something that makes sense to you, you start to kind of count that in your head, and you say, okay, well, that's interesting. Maybe let me read the study and come up with the exact settings on the indicators and scan for those settings, and then I know that I've started with some statistical edge, and then I can apply technical analysis on top of that. I really think that helps a lot of people, as opposed to people who are just out there going through the charts that they like and then drawing lines on those charts until they get something that they like, right? Start with a statistical edge, then apply technicals to that to make sure you're in the right direction. So I'm going to take some time over the next couple days, maybe even the weekend, and dig into the strategy a little more. And if I get something I'm comfortable with, that becomes a part of Stats Edge Trading. So if you're interested in that, go to statsedgetrading.com, give us a shot there. If you're interested in the setup, if you're interested in the strategy, then again, read those for yourself. Take some time and see the work that other people have done, because you might get some really good ideas from it. And until I talk to you next time, get away from the screens.